So I'm at amortization-calc.com. You can just Google amortization schedule. I'm going to put in the figures that we want: 100,000, 30 years at 7%. Okay, so the monthly payment for a mortgage of $100,000 at 7% for a 30-year term, the payment is $665.30. If you scroll down here, we see the amortization schedule. Now, I wanted to shoot this video so you guys can really understand how this strategy works, and I wanted to show you the amortization schedule in particular so you see the breakdown of each payment in the form of principal and interest, so you really understand how much money the bank is making, from the interest that you're paying. So the first payment here in November, the interest portion of the payment is $583.33, and the principal amount that the principal is reduced by is only $81.97. So at the end of month one, you have a balance of $99,918. Okay, so what we're going to do, instead of just making all 360 of these payments, and if we were to do that, it would take us 30 years to pay off the mortgage. What we want to do, we can actually pay these principal payments in advance. Like, for example, when we send in our second mortgage payment, we could send in additional amounts, principal amounts, for the future. So we can say to the bank, okay, we want to make our payment for December 2012, but we also want to send in a check for $82.93 for the principal portion of January's payment. So all in all, you're skipping over January's payment if you do that. So the following month, you make your regular mortgage payment, and you can do the same thing for the future. So you're actually allowed to do that. You have to do it the correct way, because if you don't specify and dictate which payment you want the principal to go to, the bank can actually put it towards payments at the end of the amortization schedule, like October 2042, and say that principal went towards that payment if you don't dictate exactly which payment it goes towards. So you have to make sure to do that as well. When you do send in the extra payments, you have to write out in letter form which payments the principal, the money's going to for the principal. So the goal here, guys, a better way to do this, rather than having to take money out of your own pocket, is all that money that's sitting in your checking account between the time when you get paid from work or your businesses or wherever you have sources of income. When that money sits in your checking account, it's not gaining any interest. So what we want to do is use that to our advantage and use it to pay down this mortgage. Then you might ask, once we pay towards the principal of the mortgage, how do we get that money back out? Well, what we're going to do is open up what's called a home equity line of credit, otherwise known as a HELOC. Open up a HELOC, draw the money from that, and then work to pay off the HELOC. And that's an open-ended loan, so you can control how much you owe. So then once you get paid again, you can put it right into the HELOC, so you're not paying daily interest on that money. You're saving it on your mortgage, and you're not paying any interest on it personally. So that's how the strategy works. So for the example that I used, a $100,000 mortgage, let's say you make $5,000 income per month, and your payment is $665.30. What I would do is I would take the $5,000 that I make, and this is of course after I open up a home equity line of credit. I would take the $5,000, make my mortgage payment with it, and then pay principal payments in advance with the balance of it, and then draw from the home equity line of credit when I need money to pay bills, and then once my next paycheck comes in, pay off the line of credit again, and then work to just pay off that line of credit until I can do it again. So let's see how far up the amortization schedule we can get with, for example, $4,000 in principal. Okay, so each of these payments are $80. Let's say they're each 100. It would take us 40 payments up the amortization schedule if the principal balance was 100 on each of these payments. So let's just do it by year. November 2013, or November 2012, November 2013, November 2014 is down here, and November of 2015 is 36 months later, and the principal amount isn't above the $100 mark yet. So with $3,600, you can get 3 years off of mortgage payments, guys. Look at how much money that is. If these were each $500, and they're more than that, the interest payments, if they were each $500, you would save $500 times 36 months. That's $18,000, guys, that you save by making these principal payments in advance. You're saving all this interest. So the total that you're saving, if it was in fact $500, it's more. If it was $500, you would be saving $18,000 in interest, and you would owe on your home equity line of credit $3,600. So the question is, how much interest are you going to pay on that $3,600? Well, depending on how long it takes for you to pay it off is going to factor in. But the other advantage, guys, is on a daily basis, it's going to be you're going to owe zero a lot of the time, because if you use credit cards, that extends you through a 30-day period. So then you could use your work funds or business funds to pay off the line of credit, so you never pay any interest on that line of credit. And then eventually, once you pay it off completely, you can execute this again to move yourself much further up the amortization schedule again. And you just keep doing that over and over again, and eventually you'll just have the line of credit at the end that you're working to pay off. But it works because it's an open-ended loan, and we can control how much we owe. And by making these principal payments in advance, as you can see, we're saving a ton of interest by doing that. And it's worth it, because we save more interest on the mortgage end of it than we're going to end up paying on the home equity line of credit end of it.